So imagine the UK stock market had to shut for 10 years. What would you actually hold? Now, what I've done in this video, I've picked out 10 quality super stocks that have a high return on capital, low net debt, and dividend durability on most of them. And I'm going to reveal them using a platform that allows you to do research much better. I want to go through it all. I'm going to go through a lot of stocks that you've probably never heard of before, but there's some real good ones that could be a core element around your portfolio. And I also have my own question marks about my own current portfolio. We will go through that at the end in terms of my portfolio and actually the performance of it versus the FTSE 100, which is actually doing pretty good, even though I want to change little bits of it. Let me explain throughout this video. Hi everyone. If you're new, please do slap a like on the video and subscribe and let me know what your overall thoughts are on some of these stocks. It'd be good to engage. So on the screen is my overall portfolio. We're going to go through some basic stuff. Nothing crazy. We're going to keep it super simple. But we do need to talk about a lot of stuff. Now, my performance has been really good. I've made nearly £1,000 this week, which is really quite good. But as I've alluded to it, I am looking to make maybe one or two little, very small changes on some of my smaller weights. And the reason being is because my brains have been cooked with certain things. Now, my portfolio overall, I want to go through it, but ultimately I want to showcase some of the things that we're going to go through in this video, why some stocks are very important for dividends, some are good for quality of growth and all that kind of good stuff. But the main thing about this video, which I will go through, is super stocks using Stockipedia. Now, I've alluded to before, there's a couple of my low percentage ones that I may be changing. Just because the dividends are quite low and the growth is not going to really catch up, but I want something solid. The core nucleus of this portfolio is something solid that will compound over time. And I think we might be able to adjust it very slightly, which will make it better. But we'll come on to that in a bit. Now, let's talk about what I'm using. So I'm using Stockipedia. There's a link below to this. You get 25% off, and there's also a 14-day free trial plus a 30-day money-back guarantee if you don't like it. So nothing wrong with trying it. I've tried it, 7-8 months ago, and I really enjoyed it. I built a core portfolio out of it, and it is a fantastic platform. And there is a link below, as I say. And yeah, it will blow brains. And let's talk about what the main element around this is. And there's a thing called super stocks. And what these do, they particularly outperform the market. And you can see that on the screen there. In terms of the UK, nearly a 500% return, which is mental. And what they do, they use a blend of quality, value, and momentum factors. And it's over years and years of research based from top financial investors and influential people around finance. And what we've done is we've found a load of top quality stocks that, in my opinion, are obvious. There's there's two of them I actually own myself. But a lot of these that I've picked are, I wouldn't say out of left field, but they are kind of obvious. And you look, oh yeah, that makes sense. And I'll go through it. But the reality is here, these numbers can all change, but the core element is the three factors: quality, value, momentum. Quality, obvious. How good is their balance sheet? How bulletproof are they? Obviously, value. Is it fair value? Can you get value from this? And momentum. Momentum in terms of the growth of the stock. Is it continuously getting momentum in terms of share price? And more importantly, other factors around it. So the first one we're going to talk about is Drax. You know, I own this one. Massive power plant back in the middle of the UK. And it focuses quite a lot on biomass and stuff like that, and like biofuels. It's doing really well in terms of momentum. It's doing really well with value. The quality has gone down a little bit over the last 30 days, but nothing too alarming. But reality is here, you can see in terms of their balance sheets, financial summaries and all that kind of stuff, it is all looking really good. The only thing you could argue here is maybe the cash has gone down a little bit here, but nothing too drastic. The dividends growing nicely, and they have got a nice dividend CAGR here of 11.41%, which is pretty damn good. And also their sales are compounding as well. So it is relatively healthy. But yeah, that's currently the top and bottom of it. And as you can see here, renewable energy company, pellets and stuff like that. It's pretty big. If you've ever drove past it, you'll know exactly what I'm talking about. So it's a big, massive thing. But yeah, it was kind of an obvious one, this one. So let's get into some more of the nitty-gritty ones. Now, the next one is called Kingfisher. Now, Kingfisher is a massive company, and let me kind of explain it in more detail. It's like they own like B&Q and stuff like that. Screwfix and stuff like that. And, there's other companies around the world. The reality is, yes, you can argue one thing about, oh, not many people like to go shopping these days. But at the end of the day, people will need hardware stuff. So they are kind of an industry leader for that situation. But overall, they've got a 99 rank. The momentum is a bit low. The stock price isn't doing as well, you could argue. But overall, in terms of the company, in terms of revenue and the growth of the revenue and all that kind of stuff and bits and pieces around it is actually relatively good. The dividends are actually okay as well. Yes, it stopped for a little bit during COVID and whatnot, but not terrible. And, a lot of people, it's got a 7 out of 9 health score, which is pretty good. It doesn't have the greatest dividend cargo at the minute due to COVID and stuff like that, and a bit of a wishy-washy period. But this is more a company that's kind of the forefront of the United Kingdom in terms of hardware, as you can imagine. So that's kind of the pick for this one. And as I say, like you want to go for the industry leaders, and this is, literally cemented itself as one of the industry leaders. 4.89 billion market cap as well, so it's relatively big. So yeah, it's one of those ones that I don't think is going to vanish anytime soon. It's been around for a long time as well, so that's kind of an obvious one. So here's another one. Now I know I'm going to butcher the name. To be honest with you, I'm not even going to say the name, but there it is. Feel free to look at the screen if you can read it. It's a weird name, but it is an oil rig. Put it that way. It's a load of energy companies back in the top end of the United Kingdom in Aberdeen. And the one thing I will say with this is it's got some really interesting announcements in terms of the financials. And oil rigs aren't really going to go anywhere anytime soon either, let's be honest. So with that situation, we're looking for a pillar. This is one of them. Now, it does qualify for the short selling, which is interesting. So I'm not quite sure what the demographic is, but I don't really like Mr. Altman. I'm going to say that now, as most people probably have heard of him. Now, with this, yes, it operates in the North Sea. But one of the big things here, financial brief, in terms of this, for the last 6 months, it has increased its revenue by 73%, which is pretty big. So there has been a massive increase in revenue, obviously with the crude oil prices and the production and stuff like that. So that's quite a good thing to keep an eye on. The dividends are probably not very reliable at the minute in terms of obviously how, they've only just started off and they're going quite rampant realistically in terms of the yield. So that might well come down. But if you're looking for a hold that is potentially, a pillar of, United Kingdom, you're probably looking at something like this. So another interesting company you may have heard of is Smith's News. I know, we're going to go for it. The reason why I'm talking about this is because there's still a massive, massive element around early morning end-to-end supply chain solutions of distribution of newspapers and magazines. If you're in the UK, you probably would have seen an old person with a loaf of bread and a bloody paper in one hand walking from the shops, right? That's kind of what it is. And this is the thing, they do a bit of everything nowadays. So even, as much as like recycling services and stuff like that. So it's pretty damn big. The thing is, people probably overlook stuff like this because, as I said before in the previous part of this video, we're looking for the pillar of the UK, newspapers and magazines, obviously. And we could talk about stuff like this, but it is a low cap. Now, in terms of its stock rank, its quality is high, its value is very high, and obviously its momentum is low. It may well run, but also a 98% score. But realistically, we're looking at the overall picture in terms of revenue and stuff. It's actually doing all right. Net profit increasing, all that kind of good stuff. Really nice to see. It does have a dividend and actually quite a really big dividend yield. A very, very big dividend yield, actually. It's very, very interesting. And it has a very big dividend cargo. So it is doing really well. It's probably a really interesting one. And 3 brokers actually recommend buying this and holding this. So it's pretty good. So yeah, it's one of those. It's like, oh, okay. But realistically, overall, it's looking pretty good. If we're looking at the dividend side of it in terms of like just a bit more of a fine element to it, obviously during COVID, it just went to fucking shit. And that's the problem with a lot of like stock market elements. And COVID really ruined data. And it kind of like one of those situations where you can see how different it was. Obviously, it's came back online now, but absolutely crazy to think what it was back in the day. So yeah. Now here's one that I do own. As you know, it is City of London. Quality is really high. It's a low market capitalization asset, but ultimately it's relatively strong in terms of, a bit of everything really. Not perfect in terms of dividends. It could be a lot better. There's been a bit of like growth in some years, a bit of a pullback in the others, but overall it's looking relatively good for the future. Now, again, we talk about what this actually holds, and it holds a lot of City of investment groups. So it's kind of like a bit of a combination, but it is a stock at the end of the day, and its health score is relatively high. A lot of people do recommend buying trust funds, which does make sense. But yeah, it is holding a lot of obvious things. So it's kind of like a mini ETF in a way. And it does work very, very well for the side of the market. So, Jet 2, you've probably heard of the jingle in every single TikTok these days, which is ridiculous, but it is relatively all right. The momentum's a bit low. The quality isn't perfect, but it is actually increasing. But overall, in terms of the situation, obviously since COVID, it's actually improved quite a lot, and it is growing quite nicely. You know, you're not really gonna like see. I don't think, anyone's personal opinion, Jet 2 just disappearing like Thompsons and stuff like that back in the day. The dividend growth is increasing slowly. It's quite a small yield though. But overall, you know, the growth and the forecast are looking relatively good and relatively strong. And that's the thing. Like, it already qualifies for growth investing, which is quite good for one of the screens. And yeah, I think most people have heard of Jet 2. So it kind of is one of those pillar ones in terms of, the overall situation. But as you can see here, the stock rank is 93. It is growing quite nicely. The revenue is quite nice. It's one of the obvious picks. Now, another one that may be obvious to some, but maybe not, ITV. And the streaming service of ITVX is obviously growing quite nicely. And things have been relatively steady over the last few years with this, but the stock price isn't amazing, as you can see, but ultimately it has done pretty well as a company. And a lot of people do like it. And the dividend is actually quite good, 6% yield, which is quite nice. And there has been a bit of growth over especially from 2022, but over the course of the last 2 years, not really much. But it isn't a bad asset to look at, and it's kind of an obvious one. If you watch TV, you probably know about it, and most of them are saying hold on, 8 brokers here, which is quite a high number considering. So a lot of people are interested in it. Again, you could argue a couple of things in terms of broadcasting rights and stuff, but overall, apart from the momentum being a little bit lower and sluggish as some of it, in terms of its company position and quality, it's actually up there with pretty much the industry standard. It's doing pretty well. Now, Associated British Food. You've probably heard of a lot of these brands. This is very much British. It's very much, your British sort of brands that have been around. Obviously, you got likes of Primark as well. So some pretty big ones here. Now, again, it's a simple sort of stock around food. It's been around for a long time. It's got really good momentum at the minute. It's got good quality. Value is probably quite low at the minute, but it is a 95% rank, and it actually does hit a lot of metrics in its market and in its industry, which is pretty important. So most things in terms of the numbers are actually relatively good. It does have a dividend yield. It's quite low though. But in terms of the dividend compound, it's actually quite high. So it is actually doing really, really well right now. But as you can imagine, yes, it does a lot of elements of everything in terms of the retail sector, which is actually quite important. It's been around for a while now, this company, and it is doing pretty well. So again, it's kind of, I wouldn't say it's an obvious pick, but for a lot of people looking at things, and I do hold Hilton Food, which is quite a good one, but this one's another one. And yeah, it qualifies for some of the growth investing, actually qualifies for two. So momentum screen and the quality one. So it's pretty good. Now, another stock that you may have heard of is Mighty. It's been around for a while. You've probably seen these on many, many vans. And again, it's one of those ones where it's kind of like a pillar of the UK. 93 rank on here. Now, as you can see here, in terms of the financial, the revenue just keeps on increasing. They keep getting more and more government partnerships and stuff like that. And the dividend yield is actually growing quite nicely. It seems like a really obvious one, but again, it's one of those companies that are really hard to explain because it is technology led. And it's all about like inspections and fire safety security, and it's all, a lot of companies get these in to do the work for them, especially government contracting ones. So it's quite a big one, and it does a lot of stuff. So air hygiene, asbestos, sustainable waste management. And as I say, like, you've probably heard of them. They actually, I think that, yeah, it's the Shard, I think they are based in. But you can see here, UK's leading facility management. So facility management around, obviously, everything. So it's kind of an obvious, it's kind of like Circo, if you've heard of Circo. So it's one of those, and like you can see here, 3,000 plus customers, so obviously different public and private sectors, 5.1 billion in revenue, which is huge. So yeah, it's a monster really. And the final one is called Morgan Siddall, which is a group, and they do a lot of fit outs and makeovers and stuff like that. It's quite a big thing, but something you've probably never heard of. Now, revenue wise, relatively strong. It keeps on growing. They do have a dividend, and it does have a growing dividend as well. And overall, you can see on the metrics, it's actually quite good. A lot of people are interested in this overall because it kind of fits a lot of like things in terms of just value investing. It fits growth investing. It fits two growth investing screens, and return of capital is actually relatively strong in terms of the quality. So quality of the stocks high. Value not great in terms of the value of the stock price, but more importantly, the momentum is growing, dropping a little bit, so it may well be quite good. But just to give you a bit of an idea, we're talking about like housing partnerships and muse buildings, other fit outs that it's done in the past, and there's quite a lot of big things here. So it's one of those where, as I say, it's probably something you've never really heard of before, but it does have a lot of like randomness in terms of like, you know, stuff you've maybe never heard of, but probably quite important. And now I've probably mentioned it, you probably see some of their logos. But again, yes, another situation around the pillar point of, companies pretty strong. Can't really go wrong, really. Now, this is my portfolio in terms of the quality. And as you can see, some of them are pretty high into the 80s, some of them are pretty, low realistically. So I am going to do a little change or two to my portfolio just to kind of make it a little bit healthier. Not massively, because the one that I look for more is this one. This is like, the quality and the value and the growth as a rank as itself, right? So quite a lot of them here. You've got high flyers, you've got super stocks, you've got neutral, you've got turnarounds, you've got contrarian. So there's a couple ones that, could be kind of swapped out a little bit and made better. The ETFs obviously don't count here, which is the bulk of my own portfolio. So I'm looking to maybe swap out maybe two, probably looking at maybe London Stock Exchange Group, which kind of makes more sense because it has a very, very low dividend yield. I can swap that out for a more quality stock. Maybe as well Unilever, which doesn't really perform very well on a lot of the fronts and has like a minus dividend growth yield. So it might be quite a simple one to kind of just swap out. But overall, my performance of my portfolio as it stands has outperformed the S&P, which is quite good to see. Not by much, but enough to kind of go, well, that's all right. So it's doing okay. It could be a lot worse, but yeah, I will update more in future videos. Sorry, so please do obviously like, subscribe, and stuff, and you'll get a bit of a picture. But yeah, there's certainly some stuff here in terms of quality that I could change. There's some stuff here in terms of stock rank I could change, but nothing crazy. But there's definitely two or three that I'm thinking, you know what, I could easily swap out because what I showcase in this video, there's some really solid stocks. So there we go. Hope you enjoy. I know it's a long one. I do apologize if it is a long one, but I hope it paints a picture of what can be looked at in terms of a bit of a stock. Now, for me, whether you're holding loads or not a lot or more ETFs, you've got to understand that you need to have a pillar, one that you think, wow, that's obvious. It's like American investors invest in certain things, like UK investors will invest in certain things as well. It is what it is. And when they're obvious, you just go for it.